Welcome back, Part 4, Credit Card Sales and Factoring. I'm Judith Paquette. In this video, we'll discuss how companies can dispose of accounts receivable. One of the main reasons companies want to dispose of accounts receivable quickly is they do not want to perform the work of collecting the accounts receivable, and they're willing to let another company do that for a fee. Another reason is that a company is short of cash, and they need the cash sooner than 30 days. We'll talk about the use of credit cards by companies. Now let's be clear here, we are not talking about the company-issued credit card like a Target card or an Old Navy credit card, but rather a third-party credit card, such as a Bank of America Visa card. In fact, most companies would prefer cash to credit cards. Customers who use credit cards do tend to spend more money than customers who use cash, as cash is somewhat inconvenient to have on hand all the time. So most companies accept credit cards, as it means sales will be higher. The cost to the company is that they must pay a fee to the credit card company, in this case Bank of America, and the fees range from 2 to 4%. So the issuer, the Bank of America, does the credit investigation for the customer. Bank of America maintains all the customer accounts. Bank of America undertakes the collection activities, and this can be significant, and the company just doesn't want to deal with that. And if the customer refuses to pay, the credit card company absorbs the losses. The final advantage to the company is that it gets its cash more quickly. Let's take an example. Local Burger, a local restaurant, purchases $1,000 worth of furniture for its restaurant from Crate and Barrel. Using its Visa U.S. Bank card, U.S. Bank charges a service fee of 3%. So let's pause right now and remember, whose books are we doing? We've got Local Burger, Crate and Barrel, and U.S. Bank. We are doing the seller, which is Crate and Barrel. The customer is Local Burger, and U.S. Bank is a third party. So Crate and Barrel is going to record this sale as a cash sale. Debit to cash, $9.70. Debit to service charge expense, $30. And credit to sales, $1,000. The $30 is calculated by taking 3% of $1,000. So U.S. Bank holds back $30 and gives Crate and Barrel $9.70. What's better, credit cards or debit cards? Well, if you ask a retailer, they will prefer debit cards, and that is because the fees are lower. There is also a flat fee, but the combination of the percent and the flat fee are significantly lower. So typical fees for a debit card, 0.8%. So on this same transaction of $1,000, the fee would be $8 plus a transaction fee of 15 cents. So that'd be $8.15. That's a lot lower than the $30 you saw on the credit card. Another way to quickly cash out or dispose of accounts receivable is to sell one's invoices to a factor. So you bill your own customer, you look at your accounts receivable, you take them and you sell them to a factor. Factors can be a financing company or a bank. They buy receivables from the business and then they collect the payments directly from the customers. Typically, they charge a commission to the company that is selling the receivables. And again, 1 to 3% is charged. So let's take an example. Assume that Greenbaum Furniture factors $600,000 of its receivables to Federal Factors. Federal Factors assesses a service charge of 2%. The journal entry to record the sale of the accounts receivable by Greenbaum Furniture is as follows. So Greenbaum Furniture had originally made the sale, put the money into accounts receivable. Now they're taking it out of accounts receivable. Federal Factors is giving them $588,000 and charging $12,000 for a fee. At one time when I was in retail, we used to buy jeans from Levi Strauss. Levi Strauss had to sell their receivables to a factor. They were going through hard times at that time. This ends part 4.